So in order to really understand where we're going, we first have to talk about where we've been. So to hit you guys with a little bit of stock market history, back in the early 1950s, there was a Nobel Prize winning economist. His name was Harry Markowitz, and he developed what he called modern portfolio theory. And essentially what he figured out was there's an optimal way to balance risk versus reward when you start to construct a well-diversified portfolio. So if on this axis we have risk, over here we have reward. So reward is just that, future expected return. While risk is standard deviation, is how we measure risk. And I'm not going to make everyone remember their stats class from high school or anything here, but essentially what standard deviation is volatility, or how much something is zigging and zagging over time. If you look at a stock chart, how much it's bouncing around. So what Markowitz figured out was risk and reward is not linear, as everyone at that time, would have assumed, and there's an optimal way to balance that risk and reward. If it was linear, we would take everything that we have and put it on something super risky, because in the long run you'd eventually be rewarded for that. Well, risk really is asymmetric, meaning it doesn't always work out that way. The gains are bigger, but so are the losses. And if that was true, take everything we have, we put it on Venezuelan bonds, hopefully they don't default, and eventually we'd be really rewarded for taking that risk. So really the challenge is not to pick the best investment. The challenge is more so to pick the right investment for you to meet your overall goals. Or to say it another way, whatever you need your money to do in the long run, we can back into what is the rate of return based on how much you're saving or how much you already have for you to be able to meet those goals. And then what this helps us do is let's take the least amount of risk possible to get to that expected return number. So essentially what Markowitz figured out was when we plot this graph out, we could also put different asset classes on here. Large stocks, small stocks, international, emerging markets, short-term bonds, long-term bonds. Get the idea here. So what he figured out was the line is not linear, but instead it looks something more like this, where eventually there's a break-even point here. Maybe it's right here where we are taking on more risk but not getting any more return for it. And he coined this as the efficient frontier. So an optimal portfolio should ride this line perfectly, perfectly efficient. So there's really a risk tolerance spectrum that goes from ultra aggressive to ultra conservative, and we can pinpoint exactly where you need to be on this line for you to be able to meet your future goals.